This Balyasny portfolio manager made 400 million in profits in 2 years. His name is Steve Schurr, and he most recently ran a multi-billion-dollar long-short equity portfolio at Balyasny, where he was a senior managing director and a portfolio manager. Schurr is now headed to Millennium, where he was offered at least 100 million in compensation to make the jump. How did he manage to make so much money in just 2 years? We're about to find out. We cover his investment process, how he picks long ideas, how he finds shorts, and what makes him arguably the best multi-manager PM right now. Just for context on how impressive his track record is. At the large multi-managers, most solid PMs will put up 30 to 70 million gross profits in a good year. Really good PMs might do 100 million plus, but only a tiny handful might sometimes touch 150 to 200 million in a monster year. 150 million and 250 million 2 years in a row is insane. If you plotted the distribution of PM performance, Schurr's back-to-back years would deserve a special place way out in the right there. Steve Schurr actually started his career as a financial journalist and worked at the Wall Street Journal and the Financial Times. A great lesson for anyone looking to become a successful investor. It's not always a linear path. Jim Chanos, the infamous short seller, noticed Schurr's work and offered him a job. Schurr started his career as an investor under his wing, and the rest is history. He later worked at a number of funds including Point72 and most recently Balyasny. Now he's on his way to Millennium. Steve Schurr is a short seller specialist by trade. Shorting stocks is a notoriously very difficult thing to do, even for experienced investors. Schurr is not only a masterful short seller, but he turned his successful process for picking shorts into a process for picking longs. Schurr's mindset was, hey, throughout my 17-year career as a short seller, I have 3 different categories of shorts that I've learned to almost always avoid. Why not just turn them into longs? The 3 categories are compounders, businesses with competitive moats, and shit to okay business models. A classic compounder might be a company like Nvidia. These are secular winners with massive long-term tailwinds that tend to drive nearly all long-term returns. Under the competitive mode bucket might be something like a Visa. Here the key isn't just growth, but durability. Even if these businesses with competitive modes don't grow explosively, their stability and market dominance over time provide long alpha. A mode company might not be growing at 30% a year, but it has competitive advantages that protect its profits for decades. Things like structural barriers to entry and pricing power. In Visa's case, that's network effects. The more merchants accept Visa, the more valuable it is for consumers to carry a Visa card, and vice versa. It's also switching costs. For banks, merchants, fintech partners, and anybody in between, integrating with Visa's payment systems takes time and technical work. Once built in, there's very little incentive to switch to a smaller network. Also, Visa's brand recognition, reliability, and safety track record are just second to none. At the core of Steve Schurr's investment philosophy are independent mindset and primary research. They look for ideas in non-traditional resources like podcasts, books, and industry calls. Anything that can pique their interest. Then they explore it and look for variance. Another big differentiating quality of Schurr is that his investment process is long-term oriented. He believes that there is all the money to be made for multi-month or multi-year positions. This is in stark contrast to the typical pot shop portfolio manager. At the large multi-manager hedge funds, Citadel, Millennium, Balyasny, there's a lot of emphasis on shorter-term catalyst-based trades, especially around and during earnings. The risk model at these firms demands it because they need to be generating alpha now, not later. Some PMs might be putting on a ton of weekly or monthly trades, meaning that you get in and out of position quite often. Schurr throws this short-term mindset out of the window. And while he still has some short-term ideas in his book, as demanded by the multi-manager risk model, the majority of alpha in his portfolio is generated from long-term multi-month or multi-year investments. One example of a long position directly out of Schurr's portfolio is Altria. Schurr and his team estimated it being an extremely attractive risk-reward trade, with more than 100% upside in 12 to 24 months and only 5% downside. For quick context, Altria is the dominant US tobacco company. The cigarette industry has been declining since 1960s, with volumes going down. But companies have historically been able to offset these declines with steady price increases. Recently, the rapid rise of vaping, much of it illicit disposable products, imported from China has been destroying cigarette demand further. Schurr's team estimated that over 60% of vape consumption in the US is illegal and believes there's strong evidence of upcoming federal and state crackdowns on these products. His thesis was that this regulatory shift will funnel a meaningful share of the vape market back to the FDA-approved players, where Altria is one of only 3 companies with approved products. The key to making money in this case is whether the free cash flow will remain high and stable. Even if Schurr's thesis is wrong, historically in the modern era, Altria's trough multiple has been around 5.5 times earnings, and so the downside is limited. Regulation has historically widened Altria's moat instead of limiting its growth. In 1998, there were regulation and payments imposed that were so burdensome that only incumbents like Altria could survive. Even without growth, Altria's high and enduring free cash flow yield likely means strong long-term returns through dividends and buybacks, which is what makes the downside limited. This is a 1 to 2 year position that Steve Schurr's team put on, not a monthly or quarterly one. Schurr just plays a different game to other multi-manager PMs. One of his core mantras is look where no one else is looking. While the typical portfolio manager might only be looking at highly liquid, mid, large, and mega cap names, and rightfully so by the way, because it allows them to enter and exit out of positions quickly, as well as size up positions, Schurr likes to look where no one else is looking. Wall Street is an echo chamber, he says, and good investors look outside of the normal channels. Schurr says that his team thrives in obscurity and look for stocks with less than 3 teams covering the name. His team even likes companies with market caps between 1 billion and 5 billion. Most multi-manager PMs typically don't look at any stocks under market cap of 5 billion. Of course, with smaller caps, there still has to be enough liquidity for Schurr's team to get involved. This means that the stock trades enough daily volume in dollars, not just shares. For Schurr, Edge lives in the right market cap range, not too efficient and not too illiquid. On the short side, Schurr has developed forged in fire thematic baskets that he looks for in great shorts. One of the 5 major themes is disruptors without scale. These are typically new entrants or hot companies that lack the sufficient scale to be profitable or to compete against the existing larger players. A textbook example of disruptor without scale that turned into a great short was Peloton. It was once seen as a tech fitness disruptor with huge growth potential, but the business never achieved sustainable scale relative to its fixed cost base. When COVID demand normalized, the company's unit economics collapsed. High cost of acquisition, negative operating margin, and declining hardware sales without a sufficiently high recurring subscription base to absorb fixed costs. Peloton was competing indirectly against very large players, traditional gyms, Apple Fitness Plus, and low-cost equipment manufacturers. These were players with far greater scale and distribution. The stock went from over 160 in 2021 to under 5 in 2024. It really was a disruptor story, but with scaling limitations. Steve Schurr's success lies in looking where no one else is looking, combining extensive short-selling experience turned into a long picking process, a longer-term mindset, and a mix of primary research and creative intelligence.